right, it's time now for Social Climbers. Look at the stocks making waves on social media this morning. And first up, we have Barclays, preparing to cut several hundred jobs within its investment bank division. The London bank is in the midst of a years-long push to cut costs and boost profit. Now, these layoffs, they're expected to take place in the coming months. Target, on the other hand, announcing that it will double bonuses for salaried employees. The retail giant's profits, they rose higher than expected last year with an extra $2 billion in operating income. And finally, we have Starbucks in some hot water. A group of California residents have reportedly filed a lawsuit against the coffee chain, claiming that it discriminates against lactose-intolerant customers because it charges more for non-dairy milk. Now, earlier this week, Starbucks shareholders, they voted against a proposal that could have set the stage for the company to lower prices for plant-based milk. In a statement, Starbucks said that the price for non-dairy milk varies by market and it depends on a mix of considerations. And you can follow all of the latest company buzz on TREN Go on your Bloomberg terminal. Now, coming up, a CIO's view of the U.S. economy. Alan McKnight, Regions Bank CIO, he joins us next. This is Bloomberg. Well, Fed Chair Jerome Powell said multiple times yesterday that the U.S. economy, it continues to perform well. So let's get the perspective now from the regional banks. We're joined now by Alan McKnight. He is Regions Bank CIO. Alan, great to have you with me. Let's start with the dot plot because no change to expected rate cuts. Still 3 penciled in for 2024. But it was interesting that no change came alongside a bump up in expected inflation and expected growth. How are you reading that?
Our take on it is that it's really just an extrapolation of what we saw at the end of last year, as we saw growth come in a little bit better than expected in Q4 of 2023. So the numbers are really just supportive of that. And on the inflation front, I think they're acknowledging that it continues to be a bit more sticky than they would like, but it is coming down. So the trend is right, but maybe not quite as quickly as they would have hoped, but not enough to really shift their view.
I do want to talk a little bit, too, about the neutral rate, because that was another thing that changed, that when it comes to the Fed's longer run median Fed funds rate, that was bumped up to 2.6. Of course, prior it was 2.5. And if we're heading into that higher for longer environment, I know that that's a subject of debate. How does that change how companies actually operate in this economy?
I think what it reinforces is that the economy is still very strong, but that the Fed is acknowledging again that maybe inflation will be slightly higher than what they've anticipated over the short to intermediate term. And then over time, from a corporate perspective, when you look at where the cost of capital is, it's still very reasonable in terms of getting business done. So I think when you look at what we're going to hear from earnings as we get into the Q1 earnings season, as you start to look out over the course of this year, we still think that the cost of capital is at a rate and at a level, when you think about the neutral rate and then pricing capital off of that, that is very reasonable from a corporate perspective.
And Alan, hold tight. We do have some breaking news, and that is that the U.S. Justice Department suing Apple in an antitrust case over the iPhone. Of course, Bloomberg News had reported that lawsuit could come as soon as Thursday. Now we have the confirmation. Let's just read that one more time. Of course, the U.S. Justice Department suing Apple in an antitrust case over the iPhone. You take a look at the reaction in Apple shares right now, and they are moving lower, currently down about 2%, 2.2%, and accelerating there. So we're going to continue to follow that story and bring you more details as we have them. But let's get back to this market and this economy, because it's interesting to see how the market is receiving this. Of course, Alan, green on the screen, both from big tech to some of the other names in that index as well. Feels like a bit of an everything rally. I mean, is that sustainable?
Well, our thought has been since the end of last year that we need to see a broadening of the rally. We had such an incredible uptick at the end of last year. And to your point, it was really all assets up all the time. And what we've seen over the course of the first part of this year is that finally we're starting to see a bit of a broadening. The other 493 stocks that have really lagged a bit compared to the Magnificent Seven are picking up a little bit of steam. Now, the reality is over the course of this year, we're probably going to see a little bit more volatility. We're going to start inching towards the election. And because of that, it's probably going to be a bit choppy as it relates to returns in the market. But nevertheless, as we talked about earlier with the economy, things are still pretty good. And our hope and our belief is that as we get into earnings season, we'll hear that reinforced from corporate executives.
Well, let's talk about that a little bit more. And of course, the catalyst, what's fueling this market? Because you write in your notes that we're moving from a Fed-driven rally, of course, to a more economic and earnings-based rally. And that's interesting and exciting to me, because it feels like for so long, it's really been the macro narrative that's been fueling everything.
That's exactly right. And I think yesterday is the portrait of that, where the market really didn't respond. It was a shrug, if you will, to the FOMC meeting. And so much of it was because last year, as we started 2023, so many market participants had a draconian view of the economy and the belief that the Fed would have to cut rates at a very significant pace just to be able to keep the economy afloat. And yet the economy continued to be strong. And that disparity in views, really the expectations versus reality, drove the market rally last year from an FOMC and a cut perspective. And yet now, as we sit here today, investors are starting to look at what are earnings, growth is still good, and supportive of the valuations that we have.
And let's talk about how you're thinking about how you actually build a portfolio around some of these views. Obviously, the equity market at all-time highs or very close. How are you thinking about stocks in relation to what's going on in the fixed income market?
Certainly. So we've been big advocates for maintaining your weights to equities throughout this rally, and even coming into 2023 last year, where people were a bit more circumspect about maintaining those allocations. Within equities, we've been interested, although we have not actually made it a shift yet, in small and mid cap. Those asset classes have underperformed versus their large cap brethren. We are hopeful that we may see an opportunity, as I noted earlier with the choppiness, to maybe get into some of those names at a better valuation point. And then from equities to fixed income, we still think that bonds hold an important part of a portfolio, albeit this year it's been a little more challenging as rates have picked up a little bit. We've seen the 10-year move up by about 30 to 40 basis points. So that's been a little bit harder on fixed income returns. But we still think on an absolute basis, given where rates are, bond investors are being rewarded after many years of having such a punitive stance by the Fed in terms of low to the zero bound in rates. So we still think that bonds are really showing an opportune time to invest, albeit it's a little more dicey right now as we wait for those rate cuts.
All right, Alan, really appreciate your time this morning. Great conversation, of course, on the heels of that Fed decision. Our thanks, of course, to Alan McKnight, the CIO of Regions Bank. And let's keep talking about central banks right now, because today the Swiss National Bank became the first bank in the group of 10 to cut rates this cycle. And we had SNB President Thomas Jordan speaking to Bloomberg Television earlier today.
Look at our newest inflation forecast. It's much lower than the one that we published in December. So the inflationary pressure in Switzerland declined quite a bit, and that gave us the possibility to lower interest rates today.
And do you think you are also on the vanguard now? Are you leading the developed world in rate cuts?
Well, we are a small country, and we are not leading the world. We are looking at our situation. It's our inflation forecast, and we have to adjust our monetary policy in a way that we have the appropriate monetary conditions in order to ensure price stability in Switzerland.
After your decision, the franc fell to an 8-month low. And how far was that intended?
Well, of course, if you change interest rates, you have also the risk that the exchange rate moves at the same time. Well, we had a situation that the Swiss franc appreciated last year, first mainly in nominal terms, but then also in real terms. And that led to a situation that we had tighter monetary conditions. That helped us a lot with respect to inflation. Now the inflationary outlook is much better, and that gave us the possibility to adjust the monetary policy today.
So in the presser, you just said you will look at new data as it comes in. You take a new decision when you next meet in June. But do you think that we will see more rate cuts this year?
Well, we make no forward guidance in that respect. We have our inflation forecast. It tells you something about the inflationary risk in Switzerland and whether the risks are more on the upside or on the downside. At the moment, it's relatively balanced. But we will see what the newest data will bring us in June, and then we make our new decision at that time.
And that was Swiss National Bank President Thomas Jordan speaking to Bloomberg Television earlier today. Let's take a look at these market moves, of course, after the Fed and the SNB decisions. Bloomberg's Simone Foxman, she joins us now.
Yeah, Katie, there's been a pretty immediate reaction to this decision by the Swiss National Bank. First off, we're watching the dollar gain despite falling yesterday after that Fed news. Of course, the Swissy moving lower in response to that decision to cut, now down about 1.4% against the U.S. dollar. But it's been a big day for news from central banks overall. While the Bank of England decided to keep its rates on hold, we did see two of the most ardent supporters of rate hikes say, no, they're not really on board any longer. And of course, the question becomes, who's next? Is it the ECB? Is it the Fed? But if we flip up the boards, we'll see that the enthusiasm in the S&P 500 is continuing today, partly on the back of the strong data on existing home sales, partly on the Micron and the semiconductor story. Of course, Micron coming out with better than expected revenue outlook, saying it plans to boost capital spending into fiscal year 2025. That's helping semiconductors across the board. We're looking at the stocks up over 3%. Just about every name within this index is higher today. And from one tech story to another, we're waiting for Reddit's IPO, pricing at $34 a share yesterday. Does this mean the start of more IPOs coming for this year? We will wait and see. I'm waiting to see as well who rings the opening bell next. We had Snoo, the mascot, on this morning, which was pretty fun.
Yeah, of course. We're still awaiting some of those headlines and the start of Reddit actually trading. Bloomberg, Simone Foxman, thank you so much. And as we await for Reddit, let's circle back to some breaking news as it pertains to Apple. This breaking just a few minutes ago that the U.S. Justice Department suing Apple in an antitrust case over the iPhone. Joining us now with the latest is Bloomberg's Ed Ludlow. And Ed, what is the basis of this lawsuit?
Yeah, the accusation from the DOJ in 16 different states is that Apple has violated antitrust laws by having dominance or outsized influence over the distribution of apps. And by extension, that those policies prevent consumers from having a choice of moving away from an iOS-based handset, of which they're the maker. This is confirming something Bloomberg reported last night, almost to every single detail, but it's important to note that in the session, we're now down 2.9%, and those declines that continue to accelerate. It's the third time that the DOJ has gone after Apple in the last decade or so. They've looked at other issues like the pricing of ebooks on the iPad, for example. As you know, it follows the Supreme Court case or the court case around the battle with Epic. But you know, those stock declines of 2.9% obviously having an impact as we hit 3% at the index level as well, of Apple being the biggest drag on the S&P 500.
Yeah, it's quite traumatic, of course, this reaction in Apple. Already shares down are down about 10% for the year, so the bad year just gets worse here, Ed. And I mean, you mentioned some of the other antitrust concerns that Apple is facing. Of course, we also had the European Union earlier this month suing or fining Apple for shutting out its rival music services on the iPhone. It feels like we're talking about something that is just going to continue and continue to haunt Apple.
Yeah, Apple now down more than 3% in the session. You know, that 1.8 billion euro, $2 billion fine, the logic, if it was that Apple gives the consumer no choice. If you want Spotify, who are the main complainants in that case, you can only get the subscription and pay for it through the iOS system. What the European Union and the complainants wanted to see was the ability to go on a website on a different handset or a laptop and sign up or pay for it outside of the iOS ecosystem, therefore allowing for competitive pricing. In other words, Apple would not allow app developers to steer consumers towards a better deal. And this DOJ antitrust lawsuit is similar in the sense that it looks at the distribution of apps and how the policies keep a user contained within the iOS system. Stock now down 2.8%. What a morning.
What a morning. Ed Ludlow, thank you so much for that instant reporting. Now, coming up, softening demand for EVs. We'll talk about why Americans are thinking twice when it comes to electric vehicles and what the government could do about it. Brian Deese, former White House National Economic Council Director, joins us next. This is Bloomberg. All right, it's time now for Wall Street Week Daily, and today we're looking at the slowing uptake of electric vehicles in the U.S. Wall Street Week host David Weston spoke with Brian Deese, former White House National Economic Council Director, about the trend.
I think those headlines would make you more concerned than you should be. The demise of electric vehicles is greatly exaggerated. And so let's start with the numbers. So in 2023, there were about 1.4 million electric vehicles sold in the United States. That was almost 10% of overall sales. That was up 50% from a year before, so really significant growth. First couple of months of this year, January and February, EV sales are up about 20%, 15 to 20%. So the rate of growth is slowing, but I think that that's actually reasonably what you would expect. This is a market that as it matures and as it becomes a larger share of overall vehicle sales, expecting year-on-year 50% growth rates was never realistic. And so I think the question is, where will this growth trajectory lead out? And also, when will the appetite for those electric vehicles butt up against consumer concerns and consumer adoption? I don't think we're there yet. And so, a rate of growth that's 20% year over year would be pretty good for a lot of industries. But we're certainly seeing a slowing compared to the rate of pickup in 2022 and 2023, which was really quite extraordinary.
So I'll confess, I'm from Flint, Michigan.
Yep.
My family all came out of the auto industry, blue collar, all right?
Yep.
I lived through the 70s and 80s where basically the U.S. automakers fell behind the Japanese.
Yep.
I do think Kia is doing pretty well right now. Hyundai is doing pretty well. Tesla's doing pretty well. Is there a possible repeat of what we saw in the 70s and 80s with General Motors, Ford, and Stellantis?
Well, I think there's a risk. I think you listen to what the leadership of Ford and GM and Stellantis as well are saying. They recognize they're behind, that this is fundamentally a technology play. Electric vehicles, it's a fundamental shift in technology. It's not just an incremental shift in vehicle technology. And they were behind. Tesla, Hyundai, Kia are both ahead. That said, I think you're seeing certainly GM and Ford both invest a lot in saying we need to catch up, and we need to catch up quickly. I would say Ford's CEO Jim Farley has been very blunt about this in saying we're going to need to remake this company. We're going to need to do things differently in terms of how we organize ourselves to drive innovation to actually catch up and catch up quickly in a growing global market as well. So I am hopeful that what we'll see is that kind of commitment actually manifests in the marketplace, and we've certainly seen we're seeing those companies increase their sales sequentially as well. But I think that's always a risk, right? We're going to have to stay ahead, and it's a dynamic global market.
What about the role of the government? Obviously, there are subsidies in the Inflation Reduction Act to really promote EV purchases. But does the government need to remain in this game for an extended period of time in order to make it work?
The single most important thing the government needs to do is to backstop the build-out of an electric vehicle charging infrastructure. It's interesting if you look at the cost effectiveness of public investment to actually reduce emissions across time. There's probably no higher bang for buck investment than a public investment in infrastructure. And if you think about it, it makes sense, right? Who's going to build out the backbone of chargers across the country to help address range anxiety and give people a sense that this will be as easy as owning an internal combustion vehicle? The good news is the government is doing that and backing that in a significant way. That was part of the bipartisan infrastructure bill that we passed in 2021. And that money is now hitting the streets, and we're starting to see a significant build out of that infrastructure. We're going to need to make sure that stays on track and that the charging experience, not just that there are chargers there, but the experience itself is easy and straightforward so that consumers feel as if this is something that they can get comfortable with.
The way things have developed, we can't talk about electric vehicles without talking about China and BYD. It's becoming a real factor globally. We just had the former President Trump talk about the possibility of manufacturing in Mexico, 100% tariffs that come across the border. How big a factor is China, and how should the government handle that challenge? Because the BYD automobiles are at a much lower price point, I believe.
They're lower price. I also think they're not particularly well positioned for the U.S. market and the U.S. consumer. Look, I think we need to step back. The challenge that we have with China right now is quite significant, and we need to have a strategy to address that. And part of what is happening is China's got very significant imbalances in its own economy, and it has to make some difficult decisions about whether it's going to double down on a strategy that over-subsidizes and often in inappropriate or illegal ways subsidizes its manufacturing base at the expense of more balanced domestic growth in its own economy and at the expense of other economies worldwide. And that overcapacity issue is an issue for the U.S. economy, but it's also an issue for the European economy. It's an issue for other economies as well. It was interesting just this week we saw Brazil actually raise the prospect of anti-dumping duties against China because they're facing these pressures as well. I do think that that Chinese model of just pushing manufacturing above all else, including above its own balanced domestic growth, is not a tenable long-term model. We in the United States, though, we need a strategy to succeed on our own, and part of that is making a commitment to invest in our own industrial capacity.
And that was Wall Street Week host David Westin speaking with Brian Deese, former White House National Economic Council Director. This is Bloomberg. Well, we are still awaiting Reddit's first trade. Of course, shares of the social media darling, they price at the top end of its marketed range at $34 each. And Bloomberg's Bailey Lipschultz here with the latest, still waiting for some action.
Still waiting for action, Katie. Still waiting for some kind of indication. Typically, the way this goes is lead left bank Morgan Stanley is meeting with the company and meeting with their DMM, the designated market maker, trying to get a sense of where they should put that first indication for where it could open, and then signal to the market if that's going to be up or down, just based simply on supply and demand dynamics. All eyes, though, on Reddit. All eyes around the deal. Again, pricing at $34. They marketed it from $31 to $34. There was some questions around whether this deal could get out at the top end of the range. Well, it did. And now the big question is, can they follow through on some of the momentum that we saw from Astera Labs? Can this mark potentially a turning point in the IPO market, just given how much we've been discussing Reddit and how all eyes really are on the company, still unprofitable, still trying to work out some of that AI flavor coming again in the wake of Astera Labs pricing well. Now it's at this point doubling from that IPO price. But the big question is, can this draw out companies on the sideline? Can this continue to draw and give returns to investors who bought at $34? It remains to be seen, and that's the big question. Again, $6.4 billion valuation. If you talk to some analysts like Bloomberg Intelligence's Mandeep Singh, undervalued. He thinks it could be worth closer to $10 billion, but the big question is, can they deliver on that AI excitement, and can they deliver a much-needed win in what's really been a slow churn as it relates to IPOs?
A lot of big questions all resting on Reddit's shoulders. Bloomberg's Bailey Lipschultz, stay close. But we do want to turn back quickly to Apple because we are awaiting a Department of Justice news conference momentarily. That, of course, after news that the DOJ is suing Apple in an antitrust case. You can see, of course, Apple shares currently down over 3%. We're going to continue to follow that story on Bloomberg Television. This is Bloomberg.
Great questions. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, we have an exclusive interview with the CEO of Micron. Sanjay Mehrotra is going to be joining us as shares surge to a record high. That's after the company boosted its outlook on AI growth.